point we discussed, I think we kind of went over it a little bit. I was catching it, but not catching it.
Okay.
And it's more so about what is actually included in the actual sale, the purchase of the merchandise, like when the delivery cost is involved, any type of extra transportation cost. And I'm trying to understand. I think one of them is it a contra, or either it goes under expenses, I think.
Yeah, so if we're the buyer, and let me share my screen and jot a few things as we go here.
Okay.
So if we're the buyer, right, and we pay delivery charges to have our inventory sent to us, we're going to capitalize that cost into our inventory account. Okay, so if, for example, we said December 31st paid $200 to have inventory delivered from supplier, okay, what we'd record on the 31st would be a debit to merchandise inventory, and then our credit to cash, assuming we paid cashier. So we're going to just add any cost of transportation for our inventory directly to our inventory account.
Okay.
Okay. If we're the seller and we pay delivery charges to have our goods delivered to our customers, that's when we record a separate delivery expense. So on this, the reverse of this example, if we said sold some merchandise, paid $100 to have sold goods delivered to the customer. We don't do anything with sales. We don't book it against that in any kind of way. We just say delivery expense. And I think the book like to use transportation out, which is a fancy way to say delivery expense. $100 cash, $100.
Okay.
Okay, so that's the two separate scenarios, the two cases we could have. If we're buying inventory and we're paying to have our own goods sent to us, we're going to include that in the cost of our inventory.
So we wouldn't have, I'm sorry.
No, go ahead.
But so we wouldn't have to have separate entries as far as the merchandise inventory. Like some of the examples in the book, it like breaks it down as far as transportation or delivery costs. It kind of breaks it down underneath the journal entries that they put in there.
Okay, are you saying they said something like purchased $1,000 in inventory from supplier and also paid $200 to have it delivered as part of one transaction, or?
Right.
Okay. So in that case, we could book two separate entries if we want, or we could just say, well, I bought $1,000 in inventory. I paid $200 to have it delivered that I would capitalize to inventory anyway. So I could just book $1,200.
Okay. So on the, I guess, for test purposes or for the final, are you going to look for it to be grouped together or separate, or does it matter as long as it's
Yeah, it doesn't matter as long as you treat it correctly, meaning however you book this delivery charge or the transportation charge, you've capitalized it to the inventory account. So whether you've done that separately or as part of the purchase of the inventory itself doesn't make a difference.
And particular, the merchandise inventory, that's all we need, or do you have to, can you put just inventory, or you want to see like merchandise inventory?
Oh yeah, either one's okay.
Okay. Now, when you're recording the discount in that, I got a little confused
Okay.
as far as when the discount is given. I think the lady at the tutoring kind of helped me out a little bit.
Okay.
But does the discount come off the total cost, or does it comes off the the 2 over 10 and then the end 30? Does it come off the total cost, or like after they return something, then that's when the 20% comes off?
Yeah.
Or the 2%?
It's on whatever we owe them or they owe us at the time of payment. So if my credit terms are 210 and 30, first of all, what's that mean? What's the 210 part mean?
The 210 is you get the discount, whatever the discount is 2%. The 10 is it needs to be paid in 10 days. The end is the total cost of without it being on discount if you pay it in 30 days.
Right. So 2% discount for whatever's paid in 10 days, balance is due in 30 days regardless of any discount. So if we said, for example, I think there was a good problem for that. Let's see if I can find it real quick. Otherwise, I'll just make one up on the fly here. Yeah, there it is. If you have your book right there, page 289, this is exercise 613. That's one that'll work anyway, 613.
You said on which page?
289. So that was 289,
Okay.
exercise 613.
Which chapter are you guys on?
Chapter 6.
Okay.
So exercise 613 is reporting net sales with credit sales, sales discounts, sales returns. I think this is what you were just asking about, Lenita. So let's book a few of these journal entries and kind of see where that takes us. So the first one says November 20th, we sold 2 items to Cheryl, who paid $400 sales price in cash. The goods cost bears, that's us, $300. So if we're making a sale on account to Cheryl here, or on cash rather, let's assume we're using perpetual inventory system.
Okay.
If that's the case, how many entries do I need to book for November 20th when I make the sale?
Perpetual, it will be 2, because there's 2 items.
Right, so I'm selling here 2 items. I'm going to book 2 different journal entries, right? The first one's going to recognize the sale itself, and the second one's going to update my inventory to reflect the goods that have left the building.
Oh, okay.
Right, so first one we say, recognizing the sale, what do I book there? She paid in cash.
They cashed $400.
$400. So cash is a debit, right? What's my credit?
Right. The credit would be the 300? No, 400.
Still 400. I want to match, right? But what account am I crediting if I'm debiting cash for this sale?
You gotta credit the inventory because it's what's going out.
I do eventually, but as part of this,
Ya la computer.
as part of this first entry, I need to recognize the actual sales revenue, right?
Oh, yeah.
Yeah. So cash and sales, my first entry for 400. I'm just going to do this so we're not turned around. And then I have to update my inventory, right? So I want to say inventory decreasing by $300. And what's my debit for that part? What else do I have to record when I make this sale to update my inventory?
Cost of goods sold.
Yeah. Okay. So anytime we make a sale, we've got those two entries. First one recognizes the actual sale itself, books us some revenue. Second one updates our inventory and moves that cost of goods sold through to the income statement. Okay.
Okay. This is the one entry just for November 20th, recognizing the cost of goods and the inventory.
Yep. Yep. So all this happens on the 20th or anytime we make a sale for that matter. Okay.
Okay.
So then on the 25th, we'll get to the discount here in a minute. 25th says sold 20 more items to Vasco for $4,000 total. Terms 310 and 30. The goods cost bears, again, that's us, $2,500. $2,500. So what do I need to book on the 25th? What's that?
That will be the 4,000.
Yep, 4,000. So what accounts am I debiting and crediting for 4,000 here?
What was the question? Sorry, I don't have my book. I use the
Okay,
ebook, so I
sure.
don't know what.
Sure. So that said, sold 20 items of merchandise to Vasco, one of our customers, at a selling price of $4,000. Cost of goods to us, $2,500, and this was a sale on account, not cash.
Then you would do it to accounts receivable.
Yeah, accounts receivable. So there's my debit accounts receivable. What's my credit here?
Sales revenue.
Sales or sales revenue. I think we're just using sales up there, right? And then what's my second entry?
Cost of goods sold.
Cost of goods sold again, and that was $2,500. And then inventory again. Okay. So again, every time I make a sale, two entries. First one to recognize the sales revenue. Second one to update my inventory.
Okay.
And then we have one more sale here before we do any payments. This one said sold 10 items to Nancy's Gym at a selling price of $6,000, terms 310 and 30. Goods cost us $4,000. So we sold them to Nancy's on credit for $6,000. They cost us $4,000. So again, first entry, same deal. This one's on credit again, so accounts receivable and sales. Second entry updates our inventory. So cost of goods sold gets a debit, inventory gets a credit.
And looking at this, we would recognize it as it being on account because of the discount and because it's not saying, on account, so we'll recognize that because of the terms of the agreement?
Right, because they gave us credit terms.
Okay.
Yep. So now we're finally collecting a payment, or excuse me, we're doing a return first, so that'll be good too. So 29 says Nancy's returned one of the items purchased on the 28th. Item was in perfect condition. Credit was given to the customer. So she returned 1/6 of what she just bought here, right? Or excuse me, 1/10. My mistake. Okay,
she bought 10 items.
She bought 10 items, she returned 1. So I need to do two things again, right? I need to record the return, and I need to update my inventory again. So how do I record the return of one of those 10 items?
That will be through the allowance.
Yeah.
Return allowance, sales return allowance, I think.
Perfect. Sales returns and allowances. One of those 10 items, so they were the exact same price, so $600. What's my credit here?
Accounts receivable?
Yes. I'm giving her credit for what she's returned. I'm saying she doesn't owe me $6,000 anymore. She owes me $6,000 minus this one item she returned. Okay, good. And then I need to update my inventory again. So now I'm putting one item back, right? So what do I need to do to my inventory account? Increase it or decrease it?
Increase it.
Yeah. So I'm putting that 1 out of 10 items back. And what do I need to credit?
The cost of goods.
Perfect. So I'm in essence reversing 1/10 of this, right? Putting one item back into my inventory and lowering my cost of goods sold. And then in that first entry again, I was giving her credit for the returned item and booking it to my sales returns account.
Okay, so the 1/10 is going to be based upon the 6,000 and the 4,000, not just the 6,000 as a whole.
Right, because we sold her 10 identical items up here. So those items cost $600 to her each. They cost us $400 each.
Okay.
Okay. So now, December 6th, Nancy is paying in full. Nancy pays in full. Okay. So what two things do I need to consider here?
The credit terms, because she's paying it within the 10 days.
Right. So she's within 10 days. Whoops. So she's getting a 3% discount. Okay. And then I need to consider what she actually owes me. Right. So we made the initial sale here. She owed me $6,000, but I gave her credit for a return of $600, right? So she owed me a total of how much?
$5,400?
Yeah, she owed me the $6,000 minus the $600. Okay. So what do I know for sure I need to do to the accounts receivable account when she pays me in full?
You have to credit it.
I do. For how much?
So 54.
Exactly. I want to make sure that her account shows a balance of 0. She's paid me in full, right? Whoops, I better leave myself a line here.
That's why I be getting confused at, because they have to all equal, right? The debits and credits supposed to equal.
They do. They need to, yeah. So are you saying as this entry, you're not sure of?
If it's 5,400 here, and it's the 6,000 up here, because we have to, because don't we have to take into account of the sales and returns down here too?
Yeah, we did already, right, by including a reduction of accounts receivable here. If we were to look at our accounts receivable ledger account, for example, here, for Nancy's, when she made that initial purchase, right, we booked $6,000 here. She owed me $6,000. But then I gave her a credit here of $600 when she returned that one item. So I booked that, right? So when she came and paid, her balance was the difference, $5,400. Does that make sense? So she's paying me in full. She owed me $5,400. So I'm going to wipe that entire amount off my accounts receivable. She's not going to owe me anything more after today.
Okay.
Okay. But how much cash did I actually receive? Was it $5,400 or some amount different than that?
A different amount, minus whatever it is subtracted by 162.
160, yeah, 3%, right? So I'm saying it's 5,400 minus
5238.
Yep, minus 3% of that 5,400. Okay, I gave her a 3% discount for paying within that 10 days. So I actually collected in cash $52.38. She's still paid in full though, so again, I'm wiping out her entire obligation here. Okay, so now my debits don't equal my credits, right? So what else do I need to book here? One more thing.
That's the part I was lost at, because you got to take into account the discount. So what goes here in the difference?
Yeah. So what you just said goes here, right? So this is sales discounts, $162, and that's the 3% discount on the 5,400.
Okay.
Okay. Remember, our sales discounts is a contra revenue account, reduces our sales. It's not treated as a separate expense. So anytime we collect payment, we want to check to see if they're in the discount period. If they are, we'll book their discount on the basis of what they owe us on that day. And then I'm going to record the receipt of cash for, whatever that difference is, the 97%.
Okay. Okay, got it.
Okay. And what else? I guess we had one more. We might as well finish this here. So December 30th, this says Vasco paid in full for the invoice on the 25th. So that was this one way up here. So Vasco's paying us in full. We are more than a month later, right? So does any discount apply? No, we're way past that. So now we're just going to have cash and accounts receivable. They didn't have any returns either, so it's just the $4,000 they owed us. $4,000 here, $4,000 here.
Okay. Okay, got it.
Okay. Okay, what else we got?
Does she have something before I ask another question?
Go ahead. I just wanted to see what was going on. That's all. Go ahead if you have questions.
My next the bad debt expenses.
Okay, chapter 8. Now, was there a specific piece of that that's...
The part about the basically, I mean, I really don't. I know you want us to understand how to book them, but what I guess what statement is being affected is one of my concerns.
Okay. Okay. And when you say what statement's being affected, do you mean when we're booking an estimate of our uncollectibles every period?
I had it marked.
Okay.
I guess can we start from the effect of the write-off part and how it affects? I think I understand the how to adjust it.
Okay.
But I guess understanding the contra account of the allowance for doubtful accounts.
Okay.
And I don't think I'm explaining it right.
That's okay. Well, I'll recap a few things, and then you can tell me if I'm missing what you're trying to get at or what you're unsure of. So in Chapter 8, we talked about how to report our receivables from a net realizable value standpoint. So basically what we said there is on our balance sheet, we should be showing accounts receivable at some amount that I'm owed in total. So let's assume that's $10,000 just for quick argument's sake here. Also on our balance sheet, we're going to see a contra account called AFDA. That was our allowance for doubtful accounts, right? Let's say that's $2,000. So AFDA reduces the amount of our accounts receivable that we expect to collect. So what we said there was our net AR, our net realizable value is going to be the difference between those two. So we always want to report those three numbers. Our gross accounts receivable, again, the total amount that I'm owed. My allowance for doubtful accounts, what I expect to be uncollectible based on some past experience, and then a net realizable value of my total accounts receivable. So again, that says $10,000 is owed to me in total. I expect to collect $8,000 of that $10,000. Okay, I expect $2,000 to be uncollectible.
The $10,000.
Sorry,
How does that come in?
say that one more time, Lenina.
Determining the $2,000, how does that come into effect?
Yeah, so there's two different ways we came up with that, right? First way is our aging of accounts receivable method. So these are our estimation techniques for determining uncollectibles. So we used our aging of accounts receivable, and the only other one we did was our percent of credit sales. Okay. Aging of accounts receivable said we're going to look at all of our accounts receivable and we're going to develop an aging schedule. And that aging schedule is going to show how old each account is or each group of accounts, the total balance of those, and then what percent we expect to be uncollectible. So we might have accounts that are 0 to 30 days old. We might have $20,000 in those accounts. Let's just always do this. There we go. And we might expect 2% of those to be uncollectible. Then we might have accounts that are 31 to 90 days old. Let's just say that's $10,000 and we expect 10% of those to be uncollectible. And then those accounts that are extra old, maybe that's another 10,000 and we expect 40% of those to be uncollectible because they're really old. We haven't gotten payments from customers in a while. Not real likely we're going to ever get those. Okay. So aging says we're just going to factor out this uncollectible percentage by the balance in each category, and that's going to help us determine our total estimated uncollectibles. So here I would say 20,000 times the 2% plus 10% of the 10,000 plus 40% of this 10,000. Okay. And then I just come up with the total, 5,400. And I come up with a total here, 40,000. So this says, based on my aging schedule, I have $40,000 in total accounts receivable, of which I expect 5,400 to never be collected. Does that make sense?
Okay.
So with aging, once we come up with that number, we say, well, since that's my total estimate of all my uncollectible accounts, that's what my balance should be in AFDA at the end of the period. Okay. I've aged all these out. I said my total uncollectibles are 5,400. That's what I expect to never collect. So that's what my balance sheet better show for allowance for doubtful accounts.
Okay.
Okay. So then our last step there would be to say, well, what's already in AFDA? Let's say that balance was $4,000 prior to adjustment. Okay, so this is from prior periods. Current AFDA balance, $4,000. In terms of an adjustment at the end of this period, what would I have to book? I don't know what I did with the numbers here. This is December 31st, let's say. Yep, keep doing that. What would I have to book for an adjustment to fix, if you will, or update my AFDA account? My total uncollectibles should be $5,400. My carry forward balance was $4,000. So what am I going to have to do to AFDA to make that happen?
Increase it?
I am. I'm going to have to credit AFDA for how much?
1,400.
Yeah, $1,400. And what's my debit going to be?
Is that the contra account?
AFDA is my contra asset account. So my other account is what here? What's my adjustment for uncollectibles, always look like? What's that other account we had? It hits the income statement. That helps. Bad debt expense. Okay.
Oh, okay.
So my adjustment for uncollectibles every period always has these two accounts in it. Always bad debt expense. That's the portion for the current period that's going to hit my income statement, right? And then some change to my AFDA account.
Okay, and that's always a given if the amounts are different?
You mean if this and this are different?
Correct.
Yes. Yeah, because again, my aging schedule is going to show me what my balance should be in AFDA at the end of the period. So regardless of what I'm starting with, I need to get it to here. So in this case, we just said, well, it was most of the way there. It was $4,000 from the previous period. We needed to tack on another $1,400 to get it to the 54.
Okay.
Does that help for that part anyway? Or?
Yeah, I think so.
Okay.
I guess I'm a thinker, and I guess I'm not understanding why a business would do this. If the current amount is less than what is proposed, are they supposed to overestimate?
Well, we don't want to overestimate. We want to try to come up with as close of an estimate as we can. But GAAP says to present our financial statements in a way that's an accurate representation of our business, we need to have some estimate of uncollectible accounts. Now, we can change our estimates later. If it turns out that everyone's been paying and that trend continues, we can change our estimates and we don't have to kind of keep this here forever. But we do need to have some estimate period to period.
Okay.
Okay. So this was all aging of accounts receivable. So the other way
go ahead. So the bad debt expense and the allowance for doubtful accounts, that will be the journal entry for this particular situation that you have on here.
Yes. Yep, this would be my period end adjustment to update that.
Okay. Okay.
Okay. So again, that's our aging of accounts receivable. The other way we said we'd go about doing this is potentially using the percent of credit sales method, right? So percent of credit sales says all we're going to consider is the current period credit sales. Okay, that's all we're going to do. We're not going to look back at all of our accounts receivable, try to estimate uncollectibles based on any portion of those. We're just concerned with the current period credit sales. So we also would have a loss rate or an uncollectible rate. that we've developed based on past experience. Okay. So for example, for illustrative purposes here, let's assume that our sales were $200,000 and that our uncollectible rate is 1% of net credit sales. If we're using the percent of credit sales method, our adjustment at 12/31 is going to look the same from an account perspective as my adjustment up here. Again, always bad debt expense, always AFDA. The difference is with percent of credit sales, again, all I'm considering is the current period credit sale activity. So if that's the case, how much am I going to book to bad debt expense and AFDA for this period?
1% of the 200?
1% of the 200,000, so $2,000. Okay. For that percent of credit sales, we say, well, I don't care what was already in AFDA. I don't need to do any math there to determine where I was, where I need to be, anything like that. I just say, what were my current period credit sales? What's my loss rate, my uncollectible rate? That's what I'll base my adjustment on.
Okay. Always.
Anything about that one that's...
No, that one's pretty cut and dry. I mean, because it's just basically a percent of whatever the credit sales are.
Right, right. It's just a one-step deal for that one.
So at the end, because this is like an expense account, we would take that from the retained earnings.
Yes, this would reduce our retained earnings. Yep. What else did we have with these? Oh, write-offs. So if we're using the allowance method of accounting for uncollectibles, which GAAP says we have to, right? When we write off an account, how do we do that? Do you remember?
Is that the one with the accounts receivable and the other two accounts there?
Yeah. So when we identify a specific account we want to write off, that's a specific account that we know for some reason we're never going to collect, or we feel certain we won't collect it. Maybe the company went bankrupt. Maybe they told us, you know, they're never going to pay, whatever. That's the only time we actually hit accounts receivable itself. Okay, remember up here we're estimating our uncollectibles, but we're never touching the accounts receivable account. We're never striking those receivables off the books completely. Here, after we've identified a specific account to write off, again, that we are fairly certain will never be collected, then we're going to take it out of accounts receivable permanently. So we credit accounts receivable for that account to be written off, and we debit AFDA. Yeah. So in essence, we're taking it out of AFDA. We're reducing our allowance for uncollectibles. We're also reducing our accounts receivable.
So we don't have to do anything with the bad debt expense for that one?
Not there, we don't. Bad debt expense gets hit with our period-to-period adjustments every period when we do those estimates. But when we do the specific write-off of the account, we take it out of our allowance and out of AR permanently. Remember, when we do a write-off here, we don't have any net effect on accounts receivable. What I mean by that is if our AR balance was $20,000 before we wrote off an account, and AFDA was 4,000, our net would be 16, right? If I've now written off this account here, my AR becomes 18, AFDA becomes 2, net is still 16. So when we're using the allowance method, again, which we have to do under GAAP, all of our net calculations are getting adjusted based on our period-to-period estimates of uncollectibles. When we actually do a specific write-off, it doesn't have any net effect on our total AR.
Now I get that. I didn't get that before on the homework we were doing, and that was one of the questions about whether or not it affected your net receivables or your net.
Yep.
So now I get that. Okay.
Yep, it does not. We're really just shifting it around, right? We're saying, well, take it out of here permanently. We also want to back it out of the estimate for uncollectibles. Yep.
Okay. All right. It's going to be tough.
This part or the whole test?
Test.
Okay.
I'm nervous.
Let's see, what else? What else? Yeah, the stuff we just talked about is really the whole crux of Chapter 8, at least. So I know it's a bit of stuff, but this is really it from Chapter 8, right?
All right. So the best thing to kind of remember and take away from this, for the write-offs, that's basically going to be affected by the allowance for or the AFDA and your accounts receivable. The credit one is, and the aging, they're basically based upon the bad debt expense and the AFDA. And the AFDA is a contra asset account so that it doesn't affect the other items.
Doesn't affect in terms of, yeah, AFDA will just reduce AR, right? Yeah. So again, aging, we look back at all of our accounts receivable from the beginning of time, right, everything that's outstanding, and we base our total estimate of uncollectibles on that. Whereas percent of credit sales, we just say, well, forget all that for now. We'll just base it on our current period credit sales and go from there. And then we deal with our write-offs as we described here.
Okay. Got it.
All right. What else you got?
What I messed up on the first time, the statement of cash flows.
Okay.
I think my biggest thing was operating activities.
Okay.
And what particular items were pulling out of that, I guess.
Okay. So statement of cash flows, we classify things as one of three types of activities: operating, investing, financing. Operating are things that are kind of our day-to-day activities with running the business. So paying suppliers, getting payments from customers, paying bills, utility bills, all those kind of things, et cetera, et cetera. Okay, that's operating. Investing, for our purposes, was primarily purchasing or selling fixed assets. So property, plant, equipment, like land, machinery, all those kinds of things. Those would all be investing activities, purchase of a fixed asset. or the sale of a fixed asset, right? The cash would just be going the other direction. And then financing was, what else? So issuing new stock for cash, paying dividends, borrowing money from the bank, and also repaying any loans to the bank or to creditors in general, not just the bank necessarily. So that's really the breakout for those three, right? So if, for example, I said to you, paid $100 cash to buy office supplies, you would classify that as what kind of activity?
Operating.
Operating, good. Whereas if I said paid $5,000 to buy land, you would call that what?
Investing.
Investing. And if I said borrowed $1,000 on a note from B of A, you would call that
Financing.
financing. And if I said paid utility bill $200, you would call that
Operating.
operating. Good. What else? What else? What else?
Unearned revenue doesn't go anywhere in there, right?
Unearned revenue. Oh, good one. Received $2,000 cash in advance for services to be provided later. What would that be?
That's one of the ones I'm confused about.
Okay. So cash is involved, so it definitely is something, right? Any cash activity is going to hit the statement of cash flows. What does that sound like? Receive $2,000 cash in advance for services to be provided.
Is that still operating?
It still is, yep. Yep. If you run into trouble there, think about what it would be if I was doing the work right now. So if I said receive $2,000 cash for work just performed, that's certainly operating, right? My day-to-day activities. So no different if they're paying me in advance for that same service.
Okay, so the unearned revenue would be a part of operating activity.
Right, so here's unearned revenue. It's still operating because I'm being paid for some service that I typically provide anyway, right? It's my normal course of business.
Okay.
So the fact that they're paying me in advance doesn't change the fact that it's operating.
Okay. And any equipment would be the investing.
Right, same as land, yep. If I buy equipment, buildings, any fixed asset.
Okay.
One more. What if I said paid $1,000 for a 6-month insurance policy? What would you call that?
It's an asset, so it's operating?
Still operating, yep. Still operating. Because we're not buying a fixed asset. That's really the difference. If we're buying a fixed asset, we'll call it investing. If it's just prepaying expenses like we're doing here, we'll still call that operating.
Okay. And when you say issuing new stock for cash, that's where we're selling our stock to receive money, not we're actually investing in stocks ourselves as a business.
Right. We're receiving money from an investor in exchange for our stock. Yep.
Okay. Gotta remember that.
Good. What else we got here?
I think that's all I really had. Because you helped me with the LIFO and the FIFO the last time.
Oh, yeah, okay.
So I think I got that one down pat.
Okay. You can count on one of those. Did we talk last time about depreciation? Or do you need to, either of you?
Do what?
Do you need to talk about depreciation at all from Chapter 9? Or are you good with that stuff?
I've been avoiding Chapter 9.
Oh, okay.
Uh-oh.
Well, because I'm working kind of in sequential order, and I just finished, I'm still working on Chapter 7.
Okay.
So Chapter 9, yeah, I'm kind of putting it off till
Okay.
the end. I'm scared.
Okay. Do you want to talk Chapter 7 since you mentioned that? Is there anything from that you want to review here, Dina? Or?
I mean, I'm kind of stuck on the same thing, the LIFO, FIFO, however you say that.
Okay.
But it kind of makes sense. I guess it's just a bit more tedious as far as the math.
Sure.
So it's not really giving me that much trouble.
Okay.
It was just weird because when I use the answers that you have on the on Blackboard, and it has two different ways. It has a long way of trying to figure out the opposite. They give you like the cost of goods, the ending inventory. But then there's a shortcut. Do you care if we use the shortcut just by taking whatever the amount is? Or do you want us to work it out the long way?
Oh, no. Once you have one of them, if you want a shortcut to the second one, that's fine. Yeah. And I think what you're saying, unless I'm completely misunderstanding, is if we know our beginning inventory and we know, good God, what happened? And we know our purchases or some version of that, then we know our cost of goods available minus our cost of goods sold equals our ending.
Mm-hmm.
Yeah, if you've come up with a number for cost of goods sold first, or ending first, and you want to back into the other one, that's fine.
Mm-hmm.
Do you guys want to work through one of those, or would you rather not?
Sure, why not?
Okay. Go ahead.
Can you do one like where it was missing or something?
Where it was missing?
I could be saying it wrong. No, I think that was something else.
Okay.
No, like page 341.
3-4.
I don't know if it's something. The one cost of rising or falling. E7-9.
Yeah.
And another one was the E7-2 and E7-3. It's like it provided you the whole table or the sales beginning inventory, and it has different question marks to where you have to fill it in. What?
Gotcha. Yeah, so that was our that was our inventory flow here, basically, right? That was testing our knowledge of beginning inventory plus our purchases, cost of goods available, minus what we sold is what we ended with, and then they threw in gross profit, which sales minus cost of goods sold, right? So we can certainly do some of that too, but let me grab a LIFO FIFO one quick here, and we'll do a good one. Bear with me while I grab one off. I'm going to grab one off Blackboard. One that I can pull up on screen here. That's not chapter 8. 7. Okay. More inventory practice. Come on. There we go. Whoops, I don't know why I have the solutions in here. Let me cut this out quick. Don't look. Let's do a periodic and a perpetual. Can you guys see this, by the way?
No.
It says I'm still sharing here.
It's in the spreadsheet right now.
There we go. That better?
Yeah.
Sorry. Okay, so this one here said we started with 50 units at $5. We made a whole bunch of purchases during the month, and we had 175 units left and we were done, right, after all of our sales. And here we were using a periodic inventory system, not perpetual, right? So periodic says we only do all this costing info at the end of the period. So using that, let's determine the LIFO ending inventory. LIFO ending inventory. So LIFO, again, last in, first out. So I have 175 units in ending inventory, right? Which 175 units will I have left if I'm using LIFO, last in, first out? Will it be my oldest 175 or my newest 175?
Newest.
My newest? Newest would be...
We're going to use your newest ones first.
Right, I'm going to use the newest ones first, so I'll have the oldest ones left, right?
Yeah.
So which 175 are my oldest here?
June 22nd. No, which one is the oldest?
Oldest, yeah.
From June 1st?
Yeah, so I've got my beginning 50 at 5, right? Plus those ones I bought on June 1st, 100 at 6. Plus what else?
25 from the June 2nd one?
Yeah, 25 at 5 from June 2nd. Okay, so again, LIFO less than first out, so my oldest units are going to be the ones I have in ending inventory. I won't have gotten to those with my sales. So if I do the math out here, we've got 250 plus 600 plus 125. So what's that, 975? So the cost of my ending inventory under LIFO, 975. Okay. So LIFO cost of goods sold, how would I even begin to determine that? I know
I'm confused because
okay.
If it's last in, first out, why aren't you calculating the most recent ones?
Because I will have sold those, right, first. So if I'm doing cost of goods sold, I want to take my most recent ones, right? But in ending inventory, the ones I've got left over at the end of the month, those are going to be my oldest units. Those will be at the bottom of the bucket, right?
Yeah.
So my LIFO cost of goods sold, those are my newest ones, right? Last in, first out. So I can either do the same thing in reverse, taking my newest ones, right? Or I can think back to my inventory relationship, which is what you asked about a couple minutes ago, Dina, right? So I can keep in mind that beginning inventory plus purchases minus cost of goods sold equals ending. I still have to do some kind of tedious math either way, right? So I know my beginning was the 50 at 5, right? So that's $250. I got to do the tedious math to come up with purchases. So we'll do that in a second. Minus my cost of goods sold, which is what I'm trying to find here, is going to equal my 975 that I just calculated here. Okay. So let's see here. 600, 500. Oh boy. Better get a calculator. 525. 1600. 500. 350. Do this so you can actually see it. Okay, so those are all my purchases. So if I come up with a number for those here, 600 plus 500 plus 525, 1600, 500, 350, 4075. Okay, so this highlighted portion is true of LIFO for this periodic inventory system. Started with cost of $250. I made $4,075 in purchases. Minus whatever I sold has to equal $975, my ending inventory. So then we can solve for my cost of goods sold here. So over here we've got 43.25 minus cost of goods sold has to be that ending inventory. So if I take that away from both sides, that gives me what? I can't do that in my head, I guess.
Hold on, where'd you get 43.25?
Oh, sorry, I added these together.
Oh, okay,
Yep.
all right.
Sorry. So 43.25 minus 975 means cost of goods sold must be, God, I'm saying 33.50. 3350. Right. Because again, I know this to be true. Whatever I started with plus those purchases minus whatever I sold has to be what I had left in ending inventory. Excuse me. Or we could do it the longer way and say, well, how many units did I sell? Right, I started with 50 units. Oh boy, there's a whole bunch. So I bought 100, 200, 275, 475, 575, 625. So 675 minus 175, I sold 500 units. So I could go through and say, well, which 500 did I sell? Well, I sold my most recent 50 at 7, and I sold the next most recent 100 at 5, and I sold 200 at 8, so on and so on and so on.
That's the way that I've been doing it, I guess, the long way.
Okay, yeah. Yeah, I mean, you have to go the long way to get one of them, but usually ending inventory is shorter, right? So definitely use this way if you're comfortable doing so.
Okay. That's good.
So far, so good.
Yep.
Okay. So then we'll do the FIFO version here. If I can keep this all on the screen. Okay, so FIFO, first in, first out. So FIFO says my oldest units are being sold first, right? So the ones that are left in ending inventory are going to be my newest, right?
All right.
So I had 175 units in ending inventory. So which 175 did I have left? Did I assume I had left?
The most recent ones?
Yeah, which are the 50 at 7, plus 100 at 5 plus 25 at 8. Okay. So if I total that up, I get 350 plus 5, 850 plus 2. It's like 1,050 to me. And then I can again do my shorter version and say, well, my beginning was 250, same deal, plus my purchases. Purchases were the same. That doesn't matter which costing method I'm using, right?
Right.
Minus whatever I sold had to now equal 1,050. So if we break that down again,
we're the same process.
Yeah, 43.25 minus my cost of goods sold is 1,050 this time. Which, if we do that out, it's what?
32.72.
30 what?
32.72.
Thank you. 32.75. Yep, shortcut there, much better. Or again, we could go back and say, well, which 500 were my oldest 500? And I could start checking them off here, 50 at 5, 100 at 6, 100 at 5, et cetera, et cetera, et cetera. But I would certainly encourage you, again, if you're comfortable doing so, to back into the cost of goods sold there. Excuse me. How do you guys
this
feel?
one is using the periodic.
Say again, Lenita?
That this was using as periodic, right?
Yeah, this was periodic. So perpetual is above it here, so we can look at that one if you'd like to. Perpetual is a little more tedious,
no.
right? Oh, sorry?
Yeah. No, you don't have to. That's fine.
Oh, you
Just
sure?
wanted to make sure. Uh-huh.
Okay. Yeah, I mean, we don't have to go through it.
Unless you.
Dina, did you want to go through the perpetual one?
Why not?
Okay. So let's use this one since it's right here. So this was similar deal. We know beginning, we know all these different sales and purchases, and says this time we're going to assume it's perpetual. So perpetual says we're going to have to keep track of everything as we go, right? So one thing I kind of like to do with perpetual is make just a little table that says, you know, here's the date, here's what I purchased, if anything, here's what I sold, and here's what I had for a balance. Okay, just for my own sake. So we'll start with LIFO. So my beginning inventory on 4/1 is 100 units at $5. On April the 2nd, I sold 25 units. So what cost did those units have?
$5.
Yeah, I only had one to pick from there, so that was nice and easy, right? So my balance, I've got 75 at 5. Then I made a purchase here of 200 at 6. So over here in the balance, I want to make sure in some way, shape, or form, of course, don't have to do it the exact way I do it here, but some way to keep track of the age of each of those batches of units. So I usually like to say 75 times 5 are my older ones that I still had left. And then on the next line, oops, 200 at 6. Okay, so we're saying for the third, my balance, I had 75 at 5, now 200 new ones at 6. So now when I make a sale on the 10th, it says I sold 225 units. So which 225 am I going to assume that is using LIFO, last in, first out?
You're going to take the other 75?
Yep, the 200 at 6, and then how many of the ones at 5 here? Just 25 more. Yep. So what I have left?
50 of the 5?
Yep, just said 50 at 5. Okay. So then we purchased 300 at 7. So my balance was what after that?
350.
350, but do I want to mix and match them?
No. You want to create a different line for
Yeah,
them.
just make sure some way you keep track of the fact that 50 were at 5 that were the older ones, and that these 300 at 7 are slightly newer. So then when we get to the 28th and we say we sold 325 of them, which 325 do I assume that is under LIFO?
300 of the $7 ones.
Yep, they're all gone.
And then 25 of the $5 ones.
Perfect. Okay, last in, first out. So all those new ones at 7 are gone. I also needed 25 more at 5. So that leaves me with what?
25 of the $5.
Just 25 at 5. And then at the very end there, we made a purchase of 100 at 4. So we'll just stick those on. Oops. So now we've got 25 at 5 and 100 at 4. There. So there's my ending inventory under LIFO. 25 at 5, which is 125 bucks, and 100 at 4, 400 bucks. So my total ending inventory, just the sum of the two, 525.
I like that chart because it keeps it very clean and easy to follow along with it.
Yeah. Yeah, again, the format isn't necessarily super important, but some way to keep track of what we're buying, what we're selling, and then kind of our different batches of inventory. One other benefit, if you do kind of break it out some way like this too, is when we get to say, well, what was our cost of goods sold? It's done most of the work for us already, right? Because all I need to do is look here and say, well, I sold this, so that's 125. I sold this. I sold this. I sold this. And I sold this. And if I add all those up, that'll be my total cost of goods sold.
How long we got to take the test?
You have 2 hours and 30 minutes.
Oh, okay.
Yep.
How many questions is it?
How many questions is it? It's, let's see, so I had 10 of those account identifications in that first chart like we've had, like you had on the midterm, that first table. Then I had 10 multiple choice. Then I had, how many problems did it end up being? 6 intermediate problems, and then a whole bunch of journal entries that then transform into the trial balance and all that stuff, similar to what you had on the midterm.
Just a question for you. I don't know if you're able to give it or not, but for the items that comes after what we've done, are we putting that in the post-closing too? Or is it just kind of like what was done before and this is being added to it?
I'm not sure exactly what you're asking. The items that we added to
like the chapter 6, 7, all the chapters that we covered after the fact.
Oh, I see what you mean. Yeah. So the section that has. Oh, I'm sorry. Go ahead.
We're incorporating that with the previous, or are they kind of going to be separate?
Yeah, some of it's separate. So the stuff like the bad debt expense calculation and all the uncollectibles, depreciation is a separate problem too. But then there's also some of the stuff that's mixed in with our journal entries. So like our sale of inventory, for example, that stuff we looked at from chapter 6 momentarily, that is mixed in with just kind of our chapter 1, 2, 3, 4 journal entries.
How many questions from chapter 9 were there?
There are, let's see, there's one fairly substantial problem where you determine the depreciation expense for like a piece of equipment, and then you do some stuff with disposing of that piece of equipment, like selling it. So determining gain or loss on sale. And then I also mixed in one other very small depreciation calculation in the journal entries.
Okay, and you said you're still going to have like another virtual meeting on Friday?
Yeah, I'm going to schedule one for that day, and then I was going to shoot for Sunday as well.
Are we still able to come to your class this Monday, or was it this last Monday?
No, you could come to that Monday if you wanted, sure.
And it starts at 8 o'clock?
It does.
And which building is it in?
It's the Levine Technology Building, the one with the subway in the bottom there.
Okay.
And it's
the one where we met the last time?
Yeah, that exact same room actually, 4123. And then, of course, in addition to the scheduled stuff, if you had individual questions that came up, you certainly shoot me an email. Or if it's something you wanted to work through, we could get on here or whatever and work through it, and I could share my screen. I'm more than happy to do that, too.
Okay. I'll get to chapter 8 and 9 the next couple of days, so I think on Friday I'll be able to ask you more specific questions if I don't get it.
Okay.
But yeah, this is good to kind of reinforce what I kind of understood anyway. So.
Okay. Good deal. Anything else before we wrap it up for tonight then?
We need to know like the different equations for calculating the what was it? It was at the end of chapter 8.
End of chapter 8.
The double declining balance form. Oh, number 9. I'm sorry.
Oh, yes. Yeah. Our different depreciation techniques. Yes. Yep. So I'll recap those real quick here. I don't know why this thing was. I'm trying to share that window here.
And the turnover ratios, that's something we need to recall as well.
Yeah, I don't care about those, honestly.
About what?
The like asset turnover ratio, the receivables turnover ratio, yeah, like all those really.
They won't be on the test?
No.
Okay.
No. I don't have any purpose or motivation to make you remember those. So depreciation, though, you definitely need to know the different types, right? So we had straight line, we had the double declining balance, and then we had the units of production, right? So straight line we said was creating a depreciation expense that's the same over every period that we're depreciating it, right? So we always said to calculate it, we did take our cost of that asset minus what?
Residual.
Residual divided by
The useful life.
useful life of the asset. Okay, basically just chopping up that cost minus residual over however many years we're going to depreciate it. Double declining balance, a little bit different. Cost minus, not residual this time, right? Accumulated
Right,
depreciation times 2 over the useful life, right? So 2 is the double part. That's the double and the double declining. So we're not going to consider our residual for calculating our double declining balance depreciation expense for a given year. Only base it on the cost minus what we've already depreciated. And then units of production. That's a little bit more like straight line, though again different. Cost minus residual, but times the units produced in that period divided by the total units produced for the asset's life, right? Basically saying there what portion of that asset's usefulness did we expend this period, right? What portion did we use up? If we expect it to only be able to make 10 units its entire life, if we made 2 this period, that's 20%, right? So we apply that to the cost minus residual. So I do want you to know these 3 types and how to come up with the depreciation expense for them.
Okay.
And we can certainly do some practice with that next time.
Okay. So that's the one I think we went over, and like if the ending one, it has to be equal to the, it can't be more than the book value.
Oh,
right?
yeah. So especially with double declining balance, we want to make sure we don't depreciate it past the residual value.
Yeah,
Right, residual is not part of that calculation, so if we're not paying attention, we could inadvertently do that. We can't depreciate past the residual value.
Great. Okay.
Alrighty.
Great.
Anything else for now? Oh, go ahead.
See you Friday.
Okay, I'll be here. I'll send out the schedule and the link for that either tonight or first thing tomorrow.
Okay.
All right.
So you don't know what time it's going to be yet?
Not yet. I might even try to schedule 2 in case people have conflicts.
Okay.
Okay?
All right. Okay. Well,
Okay.
Thank you so much.
Sure. You guys have a good night, and I'll see you next time.
Okay.
All right.
You too.
All right. Bye.